Good day, fellow investors. I wake up this morning and I see this as the first suggested video from YouTube because there has been a market sell-off. I check a little bit what's going on. Their commentary is you have to buy the dip, there will be short-term turbulence, but stocks usually go up. I check a little bit on Bloomberg and hard-to-shock markets show tolerance for trouble isn't limitless. Weak US economic data on Friday puts bulls in a retreat. Of course, this is just one day, Friday. The market went down a little bit, still to where it was a month ago, and bonds also went down. The yield went down, bonds went up. In general, for the start of the year, record inflows into US exchange trend funds, everything goes well there. But that's all great and nice, buy the dip, markets, economy. Nobody discusses fundamentals. Then I check an article from Bank of America to see, okay, will they discuss fundamentals? Then they discuss how the Magnificent Seven are more expensive than the rest of the world, relative. Again, no absolute fundamental analysis. They show how the top 5 companies of the S&P 500 have 26% of the market cap, which is higher than the dot-com bubble, and that when that usually happens, the result is a very negative shock for the market. But again, no fundamentals. After bubble peak, 7 to 8 years of dead money is what you can expect compared to the previous bubbles. And then again, today the cap-weighted index is 2.5 standard deviations overbought relative to the long-term trend. Fundamentals, you're here because we do fundamentals, even if we might be the lonely voice on Wall Street. If I look at fundamentals, the current CAPE ratio is 38, just shy of the dot-com peak, higher than the 1960s, higher than the roaring 20s. And the P/E ratio is high, you can see here, going up from 7 in beginning of 1980s, because since then interest rates went nothing but down, and now the first shocks are coming when it was expected that interest rates will go back down, and now interest rates are staying stable and even going up on the 10-year Treasury. If interest rates go up higher, then valuations must come lower, and that is the key risk when it comes to investing. If you look at the median return from earnings owning stocks, that was 7% plus inflation. That is how stocks delivered 10% over the long term. Now the earnings yield is 3% plus, let's say, inflation. Long term, you should get 6% from stocks. That's a huge difference from 10 to 6%. But then again, if we compare it to treasuries, the 10-year bond US government treasury now, and usually there is always a 2% premium from stocks on the 10-year treasury. Thus, if this stays stable, we might see this again from stocks, which means that stocks need to crash 50% just to adjust to the 10-year treasury. And yes, this is just one day. We will see. I have no idea where will stocks go in the short term. The key thing is that in the short term, it depends on inflation expectations, GDP expectations, deficits, tariffs, whatever, and whether those Fed cutting rates and whether those estimations or results come above or below expectations. And then you have these daily swings. Now, this was from yesterday. Inflation expectations spiked to 30-year high. Now people expect even more inflation going forward. We have services that are driving the economic growth falling in January, industry relatively stable, Fed signals officials on hold until inflation improves. So those are all the balancing acts that are going on, and I think that watching that is a waste of time. We know the fundamentals, that is the risk and reward, and the key risk is actually the Fed and everything that everyone is watching, the moving factors, getting out of control. If the Fed lowers rate and it doesn't help, which is also something that can happen, then what? That's the key risk when it comes to this market. We know that budget deficits are there, record high, growing, interest costs are key, and then some say, well, great, the markets are crashing, the Fed will lower rates, interest rates will go down, and stocks will go up. That can also be a discussion, but we are here for fundamentals, and the key question is, can you retire on 1.2% dividend yield? Let's say that it grows 7% per year in the next decade. No recessions, no nothing, everything great, earnings growth. That would be stellar results, right? Still, it would be a 2% dividend yield in 10 years. Then it grows again 7%, which is double, triple the economic growth rate. For another 10 years, that would still be just 4% dividend yield 20 years from now. And the question is, when it comes to investing on fundamentals, can you retire on this? That is something you have to answer, because the S&P 500 will grow its dividend, maybe not 7%, maybe 4%. The question is, will it lead you to your financial goals? That's the alpha and omega question. You need to know the answer before investing. Inflation, this and that, forget about it. For more real value, subscribe, check my research platform, which much better retirement options.